little bit on what's happening in the money markets. The Reserve Bank is going to inject long-term liquidity worth $5 billion into the system through a foreign exchange swap arrangement with banks for 3 years. Now, the important point is there is going to be a liquidity deficit in the system when everyone pays advance taxes. So basically, you're pulling money out of the banking system and depositing it with the government. It takes a little time for the government to spend it. It could take up until mid-April. So until then, the system needs more liquidity. And the RBI, the difference is, until now it was buying bonds through OMOs. Now it will buy dollars. Anant Narayan, money market expert, joins us on the phone line. He's, of course, professor at SP Jain Institute. Anant, good morning. Now, what does this mean? Immediately, is there going to be an impact on dollars as well, or will the impact only be on bonds?
Morning, Lata. So look, as I read it, RBI is merely expanding its arsenal of tools to manage liquidity. So far, as you rightly pointed out, it was using open market operation purchase of bonds. It was also doing long-term repos in order to inject short-term liquidity. This is a 3-year window for somewhat longer-term liquidity to be infused without necessarily touching the bond market directly. It means a couple of things. One is market expectations of further OMO purchases by the RBI will be pared down. That by itself will be slightly negative for bonds, and you could see the longer end of the bond curve going up in terms of yields and the curve steepening. What this means for the currency markets is that the forward premia, implied in the currency markets will come down, since RBI is now proposing to do buy-sell swaps, which effectively means they'll be receiving forward premia. You will see the so-called MY4 or the cross-currency swap market come down sharply today. What that means in English is that the forward premia, especially for the longer end, will come down, making it cheaper for importers to buy in the forward market, as well as for borrowers to borrow in the dollar market and swap that into rupees. That will, normally bringing down forward premia should be weakening for the rupee, because after all, you're cheapening the cost for importers to buy dollars. But I think that impact will be negated this time around, because after all, there is a risk-on sentiment towards India, and there is talk of one-off large flows coming into the country. So the spot market might not see that much of an impact. You might see a slight weakening to start with, but that should get negated pretty soon. What this does mean is there is liquidity injection which is being proposed. Forward premia should come down. And this is an alternative to buying of government bonds. In a way, this should help interest rates across the system come down and not just bond yields to come down, which in a way is good for the system.
Okay, so you're saying, Anant, good morning. You're saying that this will reduce the cost of importer hedging, and it will also perhaps incentivize fresh ECB borrowing?
Oh, absolutely, Sonia. So look, this should bring down cost of funds for the system. Now, much depends upon where the RBI accepts this auction. So if they accept the premia at far lower than where the current market is implied, that will bring down cost of funds for the system. That will incentivize overseas investors to bring in dollars into the system and maybe buy 3-year corporate bonds. You should see, short tenor corporate bonds rallying today, especially for the good names, as well as for forward premia to come down. Okay. Yeah, go ahead, Anuj.
No, I was just thinking it's all of 34,700 crores if you multiply it with today's dollar rate. I mean, that is not even 1 month's OMO if you looked at the previous month's intervention. Is it a great deal of money to make a huge difference?
Look, Lata, we don't know if RBI stops it here at this particular $5 billion lot. Maybe they do more. They've not indicated anything. We also don't know to what extent this brings down the forward curve. Look, an extreme extension of this would be the 2013 FCNRB scheme, where RBI effectively offered a subsidized swap scheme, right? And that brought in tons of money into the system. Now, I don't think there is a fair comparison here between now and 2013.
No.
But in a way, it does incentivize, depending on where the RBI accepts the cutoff, bringing in fresh money from overseas.
Now since a lot of money coming, I don't think they'll do it at a cheaper rate than the market. They may do it at market rates perhaps. But Anant, initially you said it will be bond negative, but it is going to be corporate bond positive, government bond negative, right?
That's exactly right. Because OMO scope for OMOs probably come down, that's bad for government bonds. But because you're infusing 3-year liquidity, which could be deployed into good corporate bond credit, that's actually positive for corporate credit.
Okay, Anand, thank you for stopping by and speaking with us. So that big injection by the RBI in terms of liquidity, cost of funds could go down because of that, and that will perhaps incentivize foreign borrowers as well.
Just a word for the stock markets. Yeah. If it is corporate bond positive, it is NBFC positive.
Okay.
So we must keep that in mind. NBFCs will be able to borrow more cheaply in the corporate bond market.
Okay.